Hey, let's bring in Steve Leisman now, our senior economics reporter, who can shed some more light on when the Fed actually may act. You heard the professor, Steve. He's far from the only one. I'm betting that you think the Fed's a little behind the curve at this point. The fact of the matter is, it sounds like they may try and get ahead of it sooner than we think.
I think the better way to say it, Scott, might be a little less behind. I think that's what they're aiming for here. Look, the Fed was trying to be behind the curve. That was their aim. That was their goal. They were trying to let inflation run and get the average inflation rate up to 2%. I think they misunderestimated what would happen with supply shortages and really getting things going when you stuffed a lot of money in people's pockets and how much they would spend relative to the supply and the supply shortages that were out there. But what we're hearing now, Scott, is that the new potential taper timeline has the Fed, in fact, announcing that taper in September. And you'll remember our CNBC surveys a month ago had that in November or December. So that's pulling that forward by a couple months. October or November for the actual taper to begin. And you remember that was December or January 2023. And the length of the taper would be 8 to 10 months, which would clear the way for possible rate hikes. And I think what the professor said is fascinating. Who's afraid of a 1% funds rate? If you think about what it would take for the Fed to get to a 1% funds rate, even if it began on day one of the 10th month of the taper ending or the 8th month, you would not be at 1% until well into 2023. So if that's a glide path the professor requires for his investment, it is well oiled.
You know, Steve, it feels like the Fed's going to be successful in avoiding a taper tantrum because of a great taper telegraph. I mean, it's been no accident that more speakers over the last 2 weeks have been more hawkish. It's like a concerted effort to get the market conditioned, as you reported, I don't know, a month ago, 6 weeks ago at this point, that they were going to do, so that when they ultimately do the taper, everybody's cool.
You know, Scott, that's an excellent observation on several fronts. The first is that very modest reaction to our reporting today. Very modest reaction last week. I think we hit all-time new highs while we were talking about a very significant contingent of the Federal Reserve moving towards a September taper announcement. And so, yes, the Powell has been successful at conditioning the market for that. But even more so, the more interesting thing is to look at the probabilities that have been out there and what's happened to the outlook for Fed rate hikes. Those have barely budged. And if Powell wanted to accomplish two things, he wanted to avoid a tantrum and he wanted to separate in the market's mind the criteria and the actions of tapering versus changing interest rates. And it appears as if the market is kind of able to, you know, pat its head and rub its stomach at the same time when it comes to the difference between tapering and raising rates.
Tapering is not tightening, right? And he was going to go to whatever lengths he had to go to accomplish that goal, or at least get the market to believe.